So just taking a look at the numbers, and we chatted to Ian Cruikshanks at Nedbank about them a short while ago. Turnover up 10%, but you have your results from operating activities up 43%. So really just illustrating that Sentula is becoming a lot more efficient.
I think that is the case, Stephen. I think we've worked very hard in some really tough times, both internal issues and some of the external issues. And we've worked hard to fix our biggest subsidiary, which was loss-making in the 2010 year, Megacube. And they've come good in this year. They haven't made a great profit, but they're well on track to do that in the coming year.
And of course, it was only in the second half of the year that they did turn profitable. So as you enter the new financial year, how's Megacube looking?
Well, I think if you take the same period last year, we were still working our way out of a couple of loss-making contracts. So this time last year was particularly tough for Megacube. They made a significant loss in the first half. They clawed that back in the second half, and really we're on a stable footing now with Megacube, which puts the whole business, I think, on a much more stable footing.
Tell me how you're seeing the environment at the moment, because it still is quite uncertain. We've come through the global recession. We have seen commodity prices recover, but again under pressure. So global growth very unpredictable at this stage. How are you seeing the environment for an operator like Sentula?
Look, I think we have two components to the business. Obviously, our earth-moving component and the exploration drilling. Earth-moving mostly focused on the coal industry. The coal industry saw a nice uptick in export pricing later part of last year. On the back of good demand, so we are seeing more work in that environment. Margins are still a bit tight, but they are improving. One of our biggest clients certainly allowed us to claw back a bit of margin. On the exploration side, that started to recover at the beginning of last year already. However, it recovered first in the African sort of sense, and then more recently we're seeing a recovery in the South African sense, in the PGM sector. So it puts us in a much better space from a strong rand-dollar exchange ratio.
But then also looking at some of those exploration operations, you're very much at the mercy of currencies as well at the same time, so the strong rand must have been a bit of a headwind for you.
It was, but at the time there was just not enough work in the South African context, and we had to switch a lot of the local work. This is a business that up until the beginning of 2010 was about 60% SA based, 40% offshore. We had to swing that to almost 80% offshore, 20% SA based last year. Fortunately, it's come back a little bit now. We're looking more like 70-30. But going offshore also presents its other risks, as we saw with some of the political risks. One of the jurisdictions we went into was the Ivory Coast, just in time for that to all blow up. Fortunately, things look like they're stabilizing quite fast there, so we'll be back in there in the next couple of months.
How did it hamper operations during the period, though?
We basically mobilized site and we had to pull out. So for the last 6 months, we've done absolutely nothing in the Ivory Coast. We made fairly large investments in getting equipment to site, but now that'll come good. And I think that's the type of business that we're in.
You said the swing's now gone to about 70-30, 70 offshore. And of course, you wouldn't like to shrink that, I'm sure. So how would you like to grow the local operation? What sort of ratio would you be happy with?
I think 60-40 is 40% local, sort of 60% offshore. That gives us a lot more comfort than where we are now. We've certainly managed to claw back a bit just because of additional exploration in the PGM sector, which I think is very encouraging. But we've invested in the offshore operations, the logistics, the infrastructure, getting our bases right in some of those countries, understanding some of the political risk, and I think it's time to get some of the payback on that.
Apart from becoming more geographically diversified, the business itself will become more diversified following the Shanduka transaction, because at present you're still very much a mining services business, aren't you? But that will change.
Yeah. Look, the underlying rationale for the Shanduka transaction is that we've had a strategy of growing a coal portfolio where we own and operate our own mines. It gives us some leverage in how we deploy our mining services assets. But aside from that, certainly in the South African environment, we're finding it increasingly tougher to tender on work if you don't have broad-based black economic empowerment credentials, the type that Shanduka brings to the party.
So, I mean, are you in a good position for those tenders now going forward?
Yes, yes. And while the transaction is premised on a very commercial transaction, that is certainly one of the underlying rationales that I think will add significant value to the Sentula business going forward.
I mean, you mentioned a couple of the headwinds you had last year, but there were a number, so you managed to turn in this result despite those. One of those was a 71 million rand impairment charge, and that was on some of the dump trucks. But, I mean, those were bought during the peak of the resources cycle, yes, weren't they?
They were bought in the peak of the cycle, and obviously at a much weaker rand-dollar exchange rate. So, you know, while the dollar price of those machines hasn't changed significantly, certainly in rand terms, that we've seen that change. At the same time, you know, these were machines that were bought in, used from overseas. They were deployed immediately without going through major refurbishment. In order for us to deploy them economically going forward, we believe we need to do some refurbishment on them. And this impairment really brings them back to current market value, allows us to do that refurbishment and deploy them economically in the next sort of 18 to 24 months.
Prospects, how are you positioned for the current financial year, Robin?
I think much better position than this time last year. This time last year we were still working our way through the unwinding of those unprofitable contracts, not with the visibility of work to replace that. Fortunately, that came through in the second half. Those contracts are now in place, so I think, you know, we're fairly well positioned. And similarly on the geosearch side, the exploration side, you know, we've made those investments offshore. So, you know, pulling it back to sort of a better ratio gives us a bit more robustness in their business. And
of course, you've also seen improvements in your cash flows and your debt position looking a lot better this year.
It is. You know, that came at the expense of having to sell our stake in the Kurumfontein mine at a time that was good for the business, but probably didn't support the strategy of moving into a coal environment. Fortunately, the Shenduka transaction will catch up a lot of that. But at the same time, you know, we've also managed to restructure our debt further with the banks on more favourable terms. And I think it's just a sign that people see that this company is going places again after a fairly sort of torrid past.